Good day, everyone. Today I'll be talking about stablecoins, which is one of the more interesting innovations in the crypto space. Stablecoins are pegged one-to-one against the US dollar, and this actually allows a certain number of financial institutions to arise in the decentralized finance space. All right, and one of the interesting ideas that is spun off from the idea of stablecoins is that you can actually invest it almost like a dividend stock to actually get passive income on a regular basis. My name is Christopher Ng, and I will be exploring stablecoins with you guys today. Alright, now stablecoins, as I've said earlier on, they are engineered to be pegged one-to-one to the US dollar. So imagine a coin like TerraUSD. 1 TerraUSD will always be very close to the value of 1 US dollar. So you actually do not have to experience the kind of volatility that you have when you invest in Bitcoin and Ether. Alright. Of course, this provides now a safe asset for cryptocurrency investors to actually go to in between trades. And to make it more exciting for crypto investors, you can now farm them in various protocols to get high dividends, sometimes as high as 19.4%. Right? Another use of stablecoins is that they could be kept as a war chest to exploit a crash in the stock markets. They can also be used as a contingent fund to support a leveraged portfolio in case you were to be unfortunate enough to get into a margin call situation. So stablecoins really are a fairly magical kind of invention that has sprung into being over the past few months. And the idea that you can take a financial institution or bank out of the picture means that there is actually more money to go by for the people that are actually invested in this space. All right. I'm just going to start by saying that we should always play with stable coins that have a high market capitalization, because the amount of coins in circulation is a direct measurement of how safe that investment is. Right. So if you go down the list of the top stable coins, we have USDT or Tether being in the number one position with a supply of over 80 billion. And if you go down the list, right, you will come to find USD Coin, Binance USD, and then USD Terra, which is my personal favorite, coin like Dai and TerraUSD. All right, so this is a class of instruments that are all designed to provide stability in the crypto space. Now, given this alphabetical jumble of stable coins, right, we need to have a way of thinking about how to categorize it. And so as it turns out, there are three types of stable coins. The first is fiat-collateralized, all right? It's backed by real money. And the second is that it's crypto-collateralized, so it's backed by other forms of cryptocurrency. And finally, there are non-collateralized stable coins, which I think is the most interesting of the mix. And you should spend more time looking at all these possibilities, all right? So three types of stable coins. Let's go through them one by one. The first, fiat-collateralized stablecoins, which includes a coin like USD Tether, USD Coin, USDC, they are backed by real fiat currency. So in theory, right, you can actually take a coin like USDT and you will know that there is actually $1 of cash that's actually backing it up. All right, that's theoretically what is the case. All right, but the truth is that, like many problems in the stablecoin space, not every one of these stablecoin companies have basically had a successful audit. So when it comes to USD Tether, 76% are cash equivalents, can be commercial paper. I think the most important thing is there is no contractual obligation for you to take one USDT cryptocurrency and exchange it one-to-one for $1 US. All right. So when you get into a fiat collateralized situation, do understand that there are limitations in reality that make it almost impossible to actually do a full conversion of your coins. All right. Okay. So that's fiat collateralized. All right. And I like to talk about Tether because it is the fifth largest cryptocurrency. It's launched by Bitfinex. Currently, it's got an 80 plus billion market cap. All right, and this coin has its own controversy. October 2021 was fined, I think 41 million, right, for claiming that USDT is backed by the US dollar. So it was a false claim. Okay, previously it got hacked. It's lost money before. And in 2019, the New York Attorney General even accuses the company Bitfinex of using Tether to cover up losses of $850 million. All right, and this is the bad boy of stablecoins. It's full of controversy, but it's also the largest stablecoin market cap out there. So if you are playing with Tether, right, there is always the question of how well they've done in the latest audit, and you need to compare them with how big they are. With $80 billion of market cap, the idea is that some investors might feel that it is safe because they are too big to fail. All right, but at least I want you to understand the trade-offs here. Right. If you actually look at the historical trend of Tether, it is mostly stable and it's kept its promise of being more or less one-to-one parity with the US dollar. The next coin that I think is less controversial is USD coin or USDC. It was launched by Coinbase and it currently has a 40 plus billion market cap. It sort of brands itself as a cleaner version of USDT, okay, but it's not audited, all right? The problem is that it's currently regularly attested by a law firm, I think, called Grant Thornton LLP. Historically, it's also been very flat relative to the US dollar. And I think, in my opinion, if you have a choice between Tether and USD coin actually doesn't have so much controversy. Okay, so we're done with fiat-collateralized coins. We move on to crypto-collateralized coins, and this includes examples such as DAI or Dai Coin, right, and SUSD. Now, these are coins that are backed by cryptocurrency, so you don't have actual money backing up the coin, but you have a more volatile but probably a more highly adopted cryptocurrency like Ether or Bitcoin that's like backing up this currency. Okay, so what it does is that there is a certain algorithm that is such that the more volatile the underlying collateral is, the higher the rate of collateralization. In other words, to create $1 worth of DAI, you will need $1.50 to $2 of Ether to actually back this coin called Dai. And with this over collateralization, right, there is more or less a guarantee that there is something providing value for it. Okay, so Dai Coin is an example. All right, it's launched by MegaDAO. It currently has about $12 million of market cap. Typically, you put in $1.50 worth of Ether to get $1 of Dai. All right, so after you pay off Dai, it disappears and you get your Ether back. All right, so basically, you put $1.50 to $2 of Ether into a particular project, and you get $1 of Dai back. Okay, so what investors like to do is that I'll put in Ether, the Ether still belongs to me legally, and I can make money as it goes up. I will get $1 worth of Dai, I convert the Dai into Ether, I put the money in again, right? So rinse and repeat, right? I'm able to create a leveraged position of Ether and make more money as Ether goes up, all right? So I think that's how they've arranged the ecosystem to work, all right? Dai has moments where the peg has gone crazy and is gone above $1.10 before, but overall, Dai Coin is mostly stable today. All right, and finally, I think the most interesting kind of stable coin you have are non-collateralized coins. So the advantage of having a coin that is not backed by anything is that there is nothing to audit, right? So if an auditor were to come in and say that, are you backed by US dollar? Are you backed by cryptocurrency? The answer is no, I'm not backed by anything, right? So it's almost tantamount to making money out of thin air. But I think what is very interesting is the algorithm that drives the existence of these stable coins. So effectively, how it works, the project that is supporting the stable coin works like a central bank, right? Where the demand drops, the stable coin is destroyed so that there is a lower number of coins out there in the market, so its value goes up. When the demand for the coin goes up, then what will happen is that more stable coin is created and then given to other people. So while the algorithm is running, there is a different kind of way to guarantee the existence of a stable coin. And I think the best example for this is TerraUSD. It's launched by, I think it's Terraform Labs with a 10 billion plus market cap, right? So when you're not backed by any assets, generally it's run based on this thing called the seniorage model, right? The senior-rich model means that for every unit of UST, there is a sort of a bond equivalent called a lunar coin, right? And so lunar is the way I use to incentivize investors to maintain the value of Terra at 1 to 1, right? Now, the explanation of how this works, you can find some YouTube videos with very nice graphics to explain how it works, all right? So I'll just leave it for you to read the slide. But generally what happens is that investors are incentivized to actually maintain the TerraUSD at the same 1 to 1 value with the US dollar. All right. Now, to attract people to actually come into the ecosystem, users can lend this TerraUSD under Anchor Protocol to get a high yield of over 19%, which is what makes it probably the most magical kind of stablecoin right now. And if you look at the history of UST, it almost depegged in May 2021. There was a scare, but ever since that event, I think they've wisened up and it has been stable very much since. Okay, now on top of buying stable coins, one reminder that I want to remind the people listening to this is that because most of these stable coins are pegged to the US dollar, you still have to deal with a certain amount of currency fluctuation because we deal with Singapore dollars. So one thing that you always have to remind yourself is that at the end of the day, right, your money is stable from a USD perspective. If the USD were to strengthen or weaken relative to the Singapore dollar, you will still have to deal with that forex kind of risk, and that has to be sort of modeled mathematically in a different way. All right. Okay, and so this is my final slide. Stable coins enable innovation. Right. With a coin that's pegged to a real currency, the fintech space now have a stable source of value, right? And then it can actually spin off different financial institutions that can replicate the real world. So imagine financial exchanges, banks, right, appearing in the crypto space and allowing people with a wallet to just participate in it, right? This is very fast, it's very convenient, and most importantly, right, you're cutting away the middleman, so you don't have to pay these investment bankers or subsidize their expensive Ferraris and Lambos to actually invest in whatever things that you want to invest in, all right? So I'm just going to talk about 3 interesting innovations, all right? And you can find out more, all right, as you listen to more videos from me. Okay, the first is that, as I've said before, you can build a fixed deposit business, right, where you can deposit your stable coins and earn up to 19% interest, and that can be found using the Anchor Protocol. So that's probably the most powerful application of stablecoin investing, the idea of spinning dividends off your stablecoins. And I think one of the special powers of Anchor Protocol is that you're getting a dividend every 15 seconds of your time, all right? So that's an extremely powerful and innovative kind of feature that they're bringing into the crypto space. Second is that stablecoins can then be used as a collateral to generate synthetic assets. So we've talked about using like $2 worth of Ether to generate $1 worth of Dai, right? So now in the crypto space, I can use $2 of stablecoin to generate $1 of Microsoft stock, right? And that allows me to actually create a synthetic or an engineered kind of Microsoft token, right, in the crypto space. And that mirrors the performance of Microsoft stock. Now, why is this important? Why are we trying to create this in the crypto space? If you can invest in Microsoft stock in a real exchange, you might be paying several $1,000s to get the minimum amount of 1 share, right? In the crypto space, where everything is infinitely fungible, I could actually buy Microsoft stock with $10 of my money. So I can theoretically build a wallet for my 10-year-old daughter and build a diversified portfolio with her for $100 of Singapore dollars. All right, so I think that's a very, very important and major innovation. And finally, this is something which I find most interesting. To support these stock exchanges in the crypto space, investors are often invited to participate in a liquidity pool. I can take $1 of stablecoin and pair it with this Microsoft synthetic asset. And I can pump it into the exchange so that the exchange can use it to trade with other people. And I can also earn a very decent amount of dividend while doing that. Now, the process of doing that is obviously a lot more complicated and cannot be explained on a short video, but you can achieve yields that go above 20% if you are building a sort of a delta hedge kind of arrangement with Mirror Protocol. All right, so I hope this gives you an idea of what challenges and exciting opportunities stablecoins can bring to a local investor. And as usual, none of these ideas result in a very high volatility. And I'm very pleased to tell everybody that in this situation where parts of the world is going through a war and a crisis, a stablecoin portfolio has largely been stable so far. All right, in fact, it's made quite an interesting amount of money over the past few weeks. All right, so that's all I have for you on stablecoins. Thank you very much.